Hi friends, welcome to our Tax TV channel. Tax planning is important for everyone, including working professionals. As we get into 2023, it is a good time to have a proper plan in place for tax savings in the new year. To make this easy for you, let's take a look. 1. Keep yourself updated. As we live in the information age, it is important for everyone to remain updated. Thankfully, all the information required for tax saving is available for free on the income tax website. The government has launched a very user-friendly website for taxpayers. Working professionals should ensure that they regularly visit and read the frequently asked questions and guides available on the income tax website. They are easy to understand and will make you a responsible and wiser taxpayer. Subscribe to blogs which relate to tax and investments.
2. Make the right investment to optimize taxes. Professionals should make the appropriate investments under the right heads in order to be able to utilize tax breaks offered by the law. Equity-linked saving schemes are great examples of investments that also allow taxpayers with benefits under tax law. Adding to the above, the Government of India has permitted tax deductions on the invested amount under Section 80C of the Income Tax Act for certain types of investments. The total exemption one can claim through Section 80C investments cannot exceed 150,000 rupees. These investments inter alia include Public Provident Fund (PPF), Employees Provident Fund (APF), Equity Linked Savings Scheme (ALSS), National Pension System (NPS), Sukanya Samriddhi Yojana (SSY), Senior Citizen Savings Scheme (SCSS), Fixed Deposits (FDs) of 5 years or more, etc. By adding NPS investments, Section 80CCD, one can claim an additional deduction of 50,000 rupees, bringing the total deduction to 2 lakh rupees.
Following are some tax-saving investment options that you can explore. Indian citizens can claim a deduction of taxes under Section 80, 80CC and 80CCD up to 1.5 lakh rupees under the following heads. Public Provident Fund, PPF. This saving scheme can be availed at most banks and post offices in India for a tenure of 15 years at 7.10% rate of interest, which is tax-free, and the interest rate changes every quarter. Employees Provident Fund, APF. Contribution of 12% of the salary made toward EPF scheme is counted towards the limit of 1.5 lakh rupees under Section 80C.
Deduction under other provisions of the Income Tax Act. Home loan. A tax deduction can be claimed on the interest payable on house loan under Section 24 of Income Tax Act. A tax deduction can be claimed up to 2 lakh rupees, but there is no upper limit in case the property let out on rent. Long-term capital gains. Taxpayers can save money on tax through long-term capital gains, provided they receive this gain amount by selling any long-term capital asset over a period of 3 years and then investing it in specific instruments. Donations. By donating money for social or charity purposes or by making contributions to the National Relief Fund, citizens of India can save money on tax by claiming deductions on the amount they spent on donations.
3. Buy health insurance for yourself and family. You can also save tax by purchasing a health insurance policy for yourself, including your family. Taxpayers can claim a deduction of up to 25,000 rupees for paying the health insurance premiums for themselves, including their spouses and children under Section 80D of the Income Tax Act. Under this section, senior citizens can claim a tax deduction of up to 50,000 rupees. When you purchase health insurance for your parents, you can save another amount of 50,000 rupees.
4. Pay tax and file ITR on time. As per the income tax rules, an individual or a company is required to file the ITR prior to the 31st of July or the date mentioned by the Income Tax Department every year. A penalty is imposed when you are unable to file the income tax return as per the stated due date. Filing the income tax return within the mentioned last date is vital for other purposes also, such as availing of a home loan, applying for immigration documents, doing a transaction of higher value, etc. For saving tax, different people invest in tax saving instruments at the end of a financial year. However, the effective time to invest in the tax saving schemes would be at the start of the financial year.
5. Select precise tax regime and have a corporate structure. It is also important to select the precise tax regime. Currently, there are two types of tax regimes. While furnishing the return, one can opt for any one out of two. Appropriate tax regimes would be vital for securing the maximum tax savings. An offer for a lower tax rate is provided by the new tax regime, but the same does not allow tax deductions. Therefore, when one asks for tax deductions under Section 80C of the Income Tax Act, one should proceed with the older tax regime. If not, one can opt for a new tax regime for diminishing his income tax outgo. It further underlined the importance of incorporating a corporate structure. As things stand, the tax rates for individual professionals or firms are significantly higher than the rates applicable to companies.
6. Manage cash flows and maintain proper book of accounts. Professionals who are subject to tax audits should maintain proper books of accounts in order to be able to substantiate their revenues and expenses before any tax authorities. Failure to do so can result in additional tax payments, as well as interest and penalties. Further, it is also important for working professionals to manage their cash flows. Exceeding the 50 lakh Indian rupees threshold means that professionals are no longer entitled to the benefits of Section 44 ADA, that is, the presumptive taxation scheme of Section 44 ADA is designed to give relief to small taxpayers engaged in specified profession, that is, legal, medical, engineering or architectural, accountancy, technical consultancy, interior decoration or any other profession as notified by CBDT.
Please like, subscribe and share.